Hello, ladies and gentlemen. Welcome, welcome, welcome. Not sure you can all hear me, but make use of the commentary section and let's start. Now, welcome, welcome. I'm not sure. Once again, please, if you can hear me, kindly in the commentary section, just put a plus if you can hear me, ladies and gentlemen. Let's see what's happening today. I usually have technical issues. I don't know why, but Let's see. All right, I think we're good to go now, right? We are good to go. We are good to go. All right, guys, welcome again. So today is PPI, Producer Price Index Day, right? All right, let's see what's happening. Now, yesterday we had Consumer Price Index, right? Okay, let's see who is watching now. We should be live. We should be live, guys. We should be live now. Okay, I'm gonna check really quickly if I am audible here. We should be live. Okay, we are indeed live. All right, guys. So without wasting any time, let's start. Yeah, today we're going deeper, guys. Sorry for that brief technical issue. Today we're going to have PPI. So we had two data releases, right? And if you realize they happen simultaneously, all right? Now today we're just simply going to go deeper than the headline, right? So please drop your pay in the chart, right? Yesterday we broke down particularly USD, JPY. We had our eyes on that. And yeah, yesterday was an interesting one. If you missed it out, go check it out, please. All right. Now, CPI yesterday landed at 3.8%, right? So it was slightly hotter than expected. We saw the dollar spiking a little bit, gold sold off, and the market repriced, right? Fed expectations in about, a little. It happened in a few seconds, but that wasn't the point. Today's PPI, and this one is different. You see, PPI doesn't just tell us where inflation is. It actually tells us where inflation is going. Okay? Now, most traders don't even look at this number, which is very, very interesting. Why? So we're live, and if you were with me yesterday for the CPI breakdown, the stream is the direct sequel, right? If you weren't, it doesn't really matter. You can always start afresh and go check it out. Now, here's what we're doing today. We are going to do something most trading content never does, and that is reading the actual PPI data. Okay. Yeah, I hope I'm being heard, because I'm kind of getting my screens here freezing. But anyways, ladies and gentlemen, we're not looking at any Bloomberg summary. because the source, we want to look for the source of this data, and the source always tells us things that the headline always leaves out. So with data trading, what gets left out is where the age leaves. You always want to look for what is missing, right? Because sometimes the number comes out well or as anticipated, but you find the opposite moves. So we're going to cover 3 things today. The first one is what PPI actually is and why it's fundamentally different from CPI in ways that matter to trading, to your trading as a retail trader. The second thing is we open the April 2026 report live, which I'm going to decode layer by layer. We get a headline, we start to see the what's happening, what's transpiring with the services, with the goods, and the immediate demand, where there was some kind of pricing in, all of it in just simple language, you know. And the third is trading integration, right? What are the micro setups? What is the macro framework? And a complete institutional checklist for using this data every month. So that next time, whenever you have this sort of data coming out, you're not surprised. You have an idea and you can actually start to break it down. All right. Now, if you're just joining in, please use the chat, right? We'll have a live Q&A. I always read that so we can have questions in real time. Now, we're going to jump right into it. All right. We have about, let's see. Okay, very well. Want to check one more time if we are live and you can hear me. Have a live Q&A. Beautiful, beautiful. Now we're live. All right, ladies and gentlemen, now without wasting any time, most of the retail traders has come to this website. What are they doing? They're looking for the red news here. We have core PPI, we have PPI, right? And let's refresh the page. Let's refresh that page. So at 3:30, that is, you want to go check out the time. I always start with this, and you got to also refresh that and see where you are, right? What time zone are you in, right? You always want to calibrate your charts with the New York session, understand what London session is doing. So we have a world map. It's 7:10 in New York, and it's about 12:11 in London. Okay. Now, for starters, what you want to do, guys, is understand what is PPI. I always go to the official website, BLS, the Bureau of Labor Statistics, and you want to come to the economic releases, right? Latest releases, and look for the producer price index. And there's some technical notes for you if you're just new here. According to this, it says producer price index of the Bureau of Labor Statistics is a family of indexes that measure the average change over time in prices received, right? Now, these are price changes by producers for domestically produced goods, services, and construction, okay? So, what does that mean? Let me give you the clearest possible explanation of what this actually measures, right? Because, see, there's a version of this everyone's heard, right? People read about it. And then there's a version that actually is useful for trading, and that is what we want to focus on today. The version that's actually useful, PPI, simply measures inflation, right? At a wholesale level before it even reaches any consumer out there, right? So it's pretty much upstream. Now, it's what businesses pay to make things. We're looking at resources. And the reason that matters for traders is this: whatever businesses pay today, they sort of pass on to consumers tomorrow. It's very important to understand that definition because, as you can see, yesterday we got CPI and now we have PPI. There's also some timing reasoning behind that, all right? So not always immediately, but you got to understand that it is the start, right? Not always in full, but it's kind of like a pipeline where we could start to sort of measure inflation. Now, think of it this way. The economy has an inflation pipeline, right? Where we have raw materials getting priced first, right? we're looking at oil, steel, things like agricultural inputs. Those prices feed into the immediate goods, processed materials, component packaging. You know, those feed into final demand goods. So the finished products that reach businesses and households, this is what we're looking at. And then CPI, like yesterday was thoroughly touched and explained, you know, consumer price index, which captures the consumer's side, right? We're looking at what do the consumers pay at the end of the chain, right? If you have your manufacturing industry, say a processing plant, or it doesn't matter what product they're doing, they always base their cost price on the resources available, right? Now, PPI is upstream. It is of CPI. It is the early warning system. This is where we start. When PPI starts to accelerate, especially at the intermediate and goods level, CPI typically follows within 1 to 3 months. That's very important in forecasting. Now, when we have PPI cooling, the CPI tends to follow. So there is a lag, right? It isn't exact, but it varies by sector to sector, by supply chain length, by how much pricing power businesses have. Now, the directional relationship is consistent enough that institutional economists, right, use PPI as a leading indicator for where CPI is heading. That is key. That is some alpha there. If you're just joining in, I'm really trying to break down these things so that whenever you hear fundamental news, you have an idea. Now, that is why this number matters to you as a trader. Not just because, you know, it moves, you can see these prices changing here and there, but because it moves the markets on the release date, right? Sometimes it does immediately, but most times it tells you the trajectory of inflation before it even shows up in the number everyone is watching. You know, we'll see the central bank changes in the numbers and the sentiment, and that's where we want to focus on. So here's something straight from BLS. This is the website that I want you to see directly. We have more than 64,000 price quotations per month. All right. When you have time, you could go through all that. I want to draw your attention right here. Now, these are all organized into 3 main sets of indexes, right? Let me walk you through these 3 indexes, right? Because this is the structure of the actual report we're going to be reading in the moment. Because there's a difference between looking here and going to this particular table. Structure 1 is the final demand goods. This, what you see here, I'm going to highlight it for you, right? This part here, final demand goods. We also have others that we're going to look at, but final demand goods, this is the primary framework that BLS uses now. It was introduced in about 2014, around there, and it organizes prices by who is buying the product and how far along the production process it is. Final demand means the product is sold to its end user. We're looking at a business, a household, the government, or exported. We also have intermediate demand, means the product is still sort of moving through the supply chain. It's going to be processed further before it reaches its final buyer. So there's a clear distinction which is very crucial for reading the pipeline correctly. We have structure 2. Okay, structure 2 is the commodity indexes. Commodity indexes, right? All right, so what we want to do is we want to move down here. Intermediate demand is right here, and we want to move to the services for intermediate demand. You want to come over here, and right, there we have it. Fine. Yeah, so we have commodity indexes. Now, these are just organizing products by what they are, not who buys them. That is very, very key. All right. Now, when you hear gasoline, right? PPI, gasoline, right? warehousing. All right, there we have it. Okay, one moment. Energy materials. Less foods and energy goods. Fine. So when you hear things like gasoline PPI or steel PPI, that's a commodity index. Very useful for understanding which sectors are under price pressure. Structure 3 is the industry indexes. Industrial, right? These sort of measure price change for the total output of specific industries. If you want to know what the oil extraction industry is charging at the moment, or what the trucking industry is charging, this is where it leaves. Now we have processed goods for intermediate demand, which we've already reviewed, and you could look at these final demand goods. So these are all important. Now for today's stream, I don't want to get into the core changes and all the micro sort of mechanics, but we're focusing primarily on final demand. This is what you want to look for. Final demand and the intermediate demand. All right? Because that is the pipeline picture. That is where you read the direction of inflation, not just the current level. Now, before I show you the actual data, right? One more thing is the release schedule here on the BLS government website. The PPI comes out monthly. It's very important to get that. Comes out monthly, and in a few minutes you'll see that change. It comes out monthly, typically the second or third Tuesday or Wednesday of the month, 1 or 2 days after CPI. It always comes out after CPI. Now that is the irony, because you'd expect the producers to come out first and then the consumers later on, right? It's logical, but here it comes out the opposite. Now, that sequencing is intentional. It's very intentional by the central bank and whoever is, the regulators. It is very important to understand the intentional sequencing of how they release this data, because CPI tells you what the consumers paid last month, for example, right? While PPI is telling you what is coming into the pipeline. That will affect what the consumers pay next month. If you're finding hard time, you can come back to this video and sort of absorb and compare. Now, you read them together. You always have to read them together. Are we live, guys? Hopefully we are live. Now, if you're watching, you can always come to the chat room and ask the questions. Okay. So, with that being said, we want to break this down, okay? We want to break this down, and we're going to start with just decoding this report, right? Now, look at this. April 2026 came out on 14th, right? It was released, it's going to be released today, today's May 13th, right? At 8:30 Eastern. Let's read this together, and I'm going to translate every line into trading language as we go. Now, the producer price index for final demand. What you want to look for here is the final demand, right? It starts over here. It starts over here. Now, this is the headline, the number that hits this chart over here, the calendar. This is what we see from here, right? So those websites sort of have their APIs connected, and that is how the numbers show up, right? But we're not interested in that. For context, March came in at 0.5, right? We have this. The index final demand came out at 0.5%. And if you look here, you're going to notice that the previous was 0.5%, all right? If you've ever wondered where the numbers come. Now, what does that mean? It came out 0.5% month over month. On a 12-month basis, March was 0.4%. 0.4%. Okay, for 12 months in March. Prices final demands, and it came out at 0.4%. Right. Okay. Now this is the largest annual advance since February. February, right? We have February around here, okay, and we have the total coming in at let's see, 0. There we have it. Yeah, so it was the largest. If you compare all this, you could see that for the percentage came out way different, right? And that is very significant because we're seeing acceleration. The market is walking into today's number, right? Knowing that it could be hot. That is why we have the forecasts slightly higher, which is 0.5 and 0.3. Now today's print is coming out, and once we have that, we're going to see that it's for March. We're going to compare it with the previous March data coming out, percent monthly and the 4% annual. So we have month to month, and we want to compare that with the annual data coming out, all right? So that is very important because we will start to see the pricing in and understand, you know, like what the inflation looks like. What are they sort of steering in there? And our job is to sort of decode that in real time and then run to the charts and sort of place if there are any opportunities. But that is another whole entire ball game that you need to use a checklist and have risk management and everything like that. Now let's go deeper, because when these headline numbers start, the real signal is in the split between goods and services, right? We have goods and services. So we could see final demand goods, final demand services. All right. Now, what you want to do here is pay close attention to what is happening. If you look very carefully, in March, the breakdown was final demand goods rose 1.6%, right? So the final demand, less foods. All right, we have March there, and we have, let's see, 0.7, right? 0.1, and we have final demand going all the way till 0.4%. Okay. Again, that was the largest monthly goods increase since August. August is around here, right? You could see the changes. Now, that is not like, that is just context. So you have to always compare and sort of get the understanding of where we're headed. Okay. Now, much acceleration here that we see was energy driven. Energy driven because we had a whopping 3, right, all the way from 0.5, right? It was energy driven. Okay, what else do we see? See gasoline prices jumped 15.7% in March. Okay, so this is very important to read these things here, right? And you will get some kind of context. 15.7% rise in gasoline prices, right? Right, what else did we have? We had diesel, jet fuel, and home heating. Now, today's goods number is, we're going to see that. Why does the split matter? Because look at this. Goods, right? Goods inflation, especially when driven by energy, can be more transitory. It's tied to oil prices. Everything could be tied to, most of it is tied to oil prices, because manufacturers need that. They need that for their energy, they need that for their transportation and all that. Okay, and because of that, we seeing that most of the issues we're having are also related to the geopolitical condition. If you look at the Middle East conflict, right, you got to ask yourself a question. Is it easing? Why? Because energy goods, PPI can reverse quickly. And that is meaning that it will service inflation and what businesses charge for their services. So all that has to be sort of very carefully analyzed. It reflects labor costs, rent costs, which are embedded structural pricing. Now, when services PPI is running hot, right, like today, we should be able to see, the forecast for the core is 0.3%. All right. So if it's running hot, that tells you inflation has gone beyond the energy shock and is becoming embedded in the broader economy. So what's today showing us? We want to see April data. Everything that comes out will be April data. Okay. And we're going to ask, is it goods driven again, or is it services starting to sort of accelerate? So this is a key question for the Fed's trajectory and therefore for the dollar's medium-term direction. Energy. Now, energy. This is the number under the number that almost nobody likes to read. In March, for example, where is that? In March. Okay, sometimes I just use this to locate it, right? There we have it. So index for final demand less goods, energy and services increased 0.2% in March after climbing 0.5% in both February and January. Now, for the 12 months ended in March, prices for final demand less goods, energy and trade services rose 3.6%, the largest 12-month advance since moving up 3.6% in November 2025. Okay, now what does that mean? What we're looking at is this whole issue of geopolitical constraints in Middle East, right? We're looking at disruptions, approximately 20% of global oil transit through the Strait of Hormuz, right? And that disruption went straight into producer costs. So that's the mechanism, guys. We have conflict, and then it's affecting oil supply disruptions, right? And then it leads to energy prices rising at a wholesale level. So PPI energy component spikes. Now that is another key that we're going to be looking at. We want to keep our eyes on energy. What is happening here? Okay. So we're going to break this down. Let's see how much time we have. Oh, it's actually supposed to be out now. Oh, there we have it. We have 1.4%. We also have 1%. All right. Now, you could see the spikes coming in if you're just into, scalping. We should get some. By the way, this was yesterday's trade and it should be hitting TP immediately. But what you want to do is look at the index. What is happening to the index? There we have it, guys. We're having that spike already. And this is simply telling you that we have some strength coming in, and then you see all the spikes. That is more clarification of what is happening. So you want to understand that you are alive, and what you are actually talking about is making sense, okay? Because every confirmation here will start fundamentally. Okay, now without wasting time, what you want to come here and look at this April 14th. You want to refresh that. And now it's May 13th, right? So a lot has changed. So what are the economists doing, right? They are going through this very, 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 very quickly. And what they're going to do, again, you want to look for energy. And you want to read energy here. Okay, what is happening? The index for final demand less goods energy, April, the largest advance since rising 0.6% in October for 12 months. All right, increased by jumping 4.5%. Final demand up 1.3%. Okay, 2.7%. Now, you want to understand as well, you want to get a feel of what is actually happening. Now, with energy, you can go quickly and look what is happening at Brent, right? Was there any movement? Okay. So now we're going to start decoding. Remember, you want to keep an eye on the 15-minute rule that I always say. 15 minutes should be used to sort of absorb the news today and have a trading idea. Now, we want to compare this. Now we're in April. Final demand. You want to look at energy prices. Okay, we had from 0.2 all the way till 0.5. Okay, transportation, nothing much. So goods, goods from 0.2 to minus 1.0, and then final demand, we have that. Okay, so there is definitely a significant change. Within the intermediate demand in April, prices for processed goods increased 2.7%. The index for unprocessed goods rose 4.1%. Okay, fine. Now, if energy PPI is cooling, which clearly it is not, that is your first signal that the inflation pipeline might be peaking, right? Now, if it's still hot, the CPI numbers we'll see in coming months are going to stay elevated. Now, guys, this is a section where most traders never reach, right here. So you want to pay more attention. Intermediate demand, what we see here, okay, this is what businesses are paying for goods and services. They haven't finished processing yet. They need the raw materials, right? Those raw materials that are used to make their final product. We're looking at components. So inputs that still need to be turned into something else before they reach the end user. Now, in March, processed goods. So what you want to do is also look for this section here. We have processed goods for intermediate demand increased 2.7% in April. Okay, more than half of the broad-based April rise can be traced to prices for produced energy goods, which moved up 7.8%. The indexes for processed materials, less foods and energy, and for processed foods and feeds also advanced 1.5%. and 0.4%. Now, ladies and gentlemen, I'm just showing you how it's done, right? Of course, I've integrated a very nice system that you can use. You could just fix all this data in and you get a bias, a very smooth, clean bias based on real-time information. Now, you could go check out the community later on and sort of ask these right questions. I'll be there to provide all this information. It's free, guys, so all you got to do is sort of be informed and get ready to sort of study. Now, on a 12-month basis, you also want to look at what is happening on that. And processed goods, we have more than 80% for April advanced. Okay, so you're getting a feel of what is happening. So, for example, if you're looking at oil, if you're an oil trader, you kind of have a bias, right? You can sort of have trading ideas around oil. But for purposes of this stream, we want to focus on sort of the leftover trades that we had. Now, you also want to be able to manage your trades in real time. So, with that being said, we have stage 1, which is intermediate demand in March. Intermediate demand, where is that intermediate demand? Exactly. Intermediate demand in March from the April report, right? Now you want to sort of compare both reports, both summaries, this month and last month. Where you could do that, you could come over here. Okay. And okay, we have consumer price index here. You could look at the charts here. Now this is another pretty decent way to visualize what I'm talking about, right? This is another way. If you don't want to go through the entire summary, you could just come over here and sort of play around with these, right? You could look at the 12-month percentage change from selected categories, and what you want to concentrate on is the average price data. You could look at that and Press go, see what is happening. You have more access to, for example, you want to know what bread looks like, bread, white, chicken fresh, maybe eggs. You want to look at ground, chuck, beef. You want to look at milk, fresh, whole, and etc. So this gives you a real-time perspective of those prices. So you are gauging inflation, right? Remember, this is where inflation actually starts, and you want to make sure that you are in line with all that. Okay, now let us move forward to which picture does today's data paint, right? Now we are in the applicational part, right? We want to find a way of integrating all this. So the picture today, we're seeing higher prices, right? Higher percentage, higher data coming out for the month to month. Month to month was flat. We had much 1.4%, which is really, really high. And then we also had core PPI, which is really, really, really high, according to the focus. So that is an overall stand, and this simply means it is strong, a stronger dollar. And so you have some kind of confirmation from here. We're not going to get into the breakdown, the micro breakdown, and that can always be looked at later on. You can always come hit me up in my DM and we could break that down together. Now let me put both numbers, and we want to see CPI data yesterday. The reason I'm doing this, we had CPI data and we have right, PPI data. We need PPI data. We need PPI data right there. So we got PPI data and we have CPI data, right? So I'm going to put these both numbers together. All right. So yesterday's CPI data, as you could all see, came out at 3.8% in April. The index for energy was 3.8%, right? Annual. Core CPI came out 2.8%. All items less food and energy rose by 2.8%. If you're new here, please don't get worried or overwhelmed with this information. As you practice, you'll start to understand. Core PPI less food, all right. Now the relationship I'm watching is PPI running ahead of CPI. Okay, PPI running ahead of CPI. Now we have higher percentages coming in, right? Higher data coming in, and that was also sort of confirmed yesterday. Remember, we have this lag between that, and that simply means you gotta now start to position yourself. If PPI is below CPI, usually we may be approaching a disinflationary turn. Right now, okay, if we look at both the CPI and PPI, that is going to give us a picture of what will happen between 1 to 3 months of the inflationary trajectory. Now, if you're a person who's always trading fundamentals, this will be very crucial in positioning yourself for long-term trades. If you're just getting in or scalping, you got to understand that all these whipsaws could just be, some participants trying to get in. If we don't get any crazy moves today or tomorrow, then you want to start to slow down and really start to look for entries on these asset classes. Now, based on what we've just read together, you got to ask yourself, does today's PPI data change your inflation outlook for the next 30 days or 60 days, right? If you're following, you could type higher. Do you expect a higher or lower, or even a changed expectation? When we'll have the next Federal Open Market Committee session, and we'll also be able to read the report. So, right, market by market, okay? How does PPI move your trades? I want you to open any trade, any instrument that you're trading. For those of you that are in Forex, by the way, you could also go check out what is happening with Bitcoin. Okay, nothing really moved. So that is a good sign, right? nothing like serious like a shock. And once you've decoded all the data, you want to start off all the time with the index. The index is pretty much what is moving, because when we have, in this case, hot PPI above expectations, you want to support that idea, that fundamental context with the dollar index, right? And what we're seeing now is indeed we're getting a little bit of a push there, right? But don't forget, technically you also want to look at the higher time frames and see where we're headed, right? So with that bullish sort of momentum coming in, you might want to align that with the New York session momentum and then capitalize on that. So here's a specific mechanism. You get hot PPI data, right? It signals that inflation at the producer level is still running. Now, what does that mean? It keeps the Fed hawkish. Remember, when we have higher inflation, the central bank, their main responsibility is to stabilize the economy, to come in and intervene whenever we have these inflations. Their job is to sort of control that. How do they control that? They gotta increase the rates and reduce the pressure, tweak those, play around with the pressure points and sort of stabilize the economy. Now, that keeps the Fed hawkish. What do? They delay any rate cut expectations, right? Now, this is an indicator that the 3.75% will really be hard to push all the way to 2, because we know that Trump has always been biased to reducing the rates to all the way till 2% because of the bigger picture. They have a big debt. They want to reduce that debt, and they're all finding all kinds of ways through crypto and all that kind of stuff. Now, the logic chain is identical to CPI, but the only difference when I'm using PPI is you're adding a forward dimension, right? You're moving forward. So if today, for example, we have hot PPI signaling, right? We want to now understand that CPI coming will probably also be in line with that. The market isn't just pricing, say, today's Fed stance. It's pricing a Fed that stays restrictive for longer than previously expected. That is key. All right, now PPI, cool. On the other hand, let's take an example. If these numbers came out different, right? If they came out much cooler than what was expected, right? It gives Fed more room. It gives it more room to sort of think of other ways of sorting that issue. So the dollar naturally softens as rate cuts expectations begin to be priced in at the margin. All right, guys, there's a lot more, but now basing on the candles, the practical side, what are we saying here? Nothing really significant. We just had that spike on the 15-minute, 86 pips, all right? With the DAX, you want to go to gold and see what is happening. Gold has been deeping ever since yesterday's data. Now, for those of you that entered, you probably got trapped in by that bias to the upside. All right. So you want to look for any kind of divergences between some of these pairs. You could go, and don't forget, this is just a little bit of how we break down, because there are many other factors that you have to put into consideration, right? There's a map, a liquidity map. You got to understand the seasonality, what is happening with those particular pairs. That is why I advise my community never to trade more than 2-3 instruments. You got to know your instrument really well, and only once you understand the template, the dynamic, the day, the timing, you can move on to the next one. All right, guys. Now, I know that many people like Euro US dollar. We could also go check it out. Same logic here, you want to map out your zones as well. After all that kind of stuff, the Eurozone has its own inflation dynamics. Please do not misinterpret this. We have the ECB, right? European Central Bank has been on different cutting cycles than the Fed. So there's also some divergence here. You want to make sure you're not getting in when you don't know your counterparty's stance, right? So if you get a pair like Euro US dollar, you've already kind of had an idea of what the US dollar is up to. Then you want to go to the ECB and also look at the same information. So they've already made 2 cuts in 2026, as we know. If, say, US PPI is hot, it keeps the Fed on hold, while the ECB on the other side starts to ease. Now that rate differential widens further in the dollar's favor. And then we get Euro US dollar falling. Now you can always use this for scalps. I'm not saying you can't make money. Of course you can, but I'm trying to explain to you the institutional financial participant side, right? You want to understand the entire mechanics. And this is not even touching the architecture, what is going on behind your brokerage company and the liquidity providers and all that kind of stuff. All right. Now gold is another one. You want to come here. Remember, we have times to end, we have entry times, and right now we are not entering. Gold is another one that is always the most nuanced on PPI days. The reason being is, for example, yesterday I gave you a counterintuitive insight about CPI and gold, if you remember, right? Let me give you now the PPI version. PPI hot today, right? Now in isolation, this is theoretically bearish on gold if you think about it, right? Because we have a pair XAU USD. USD strong, it means this pair has to fall down, right? Because it implies higher real rates for longer time, right? Higher real rates are the strongest headwind for gold. Because gold pays no yield. I've broken that down multiple times. Gold does not pay any yield. Now, when you can get 5% in a treasury, what does that mean? The opportunity cost of holding gold increases. But very important is this is what institutional traders right now are weighing in right now, right? We're in a world where even a hot PPI is being driven by an active Middle East conflict that has disrupted 20% of the entire global oil supply routes. Now that same conflict that's driving PPI higher is also simultaneously driving gold demand as a geopolitical safe haven. So we have two forces and the opposite direction of gold. Now, the resolution of that tension that we are seeing, the question the market is answering, like for instance today, is does the rate pressure dominate or does the safe haven bid dominate? Now, gold's reaction to today's PPI will tell you which force is winning right now, you know? And that is not just some kind of random read, right? You got to understand the sophisticated complexity between these instruments, all right, before you even touch the technical side. So, getting right into this, we want to separate informed positioning and just guessing. Ladies and gentlemen, there are many strategies, but we are professional. We want to handle this with care, with an understanding and the right information. And we can go on with oil, with Brent. Now, I want to know how much time we have left. We want to see how much time we have left. Okay. I want to see how much time we have. All right, we're passing the 1 hour time frame already, but I wanted to break down oil, Brent oil. Where is oil now? There you are, oil. Okay. Now, remember, before you even get into any of these trades here, this is sort of what the breakdown looks like. We will break this down, the webinars, we'll have that on the weekends, and you can interact and ask questions. We'll also be breaking down indices, right? And where PPI sort of, how it affects equities and all the other positionings, right? This is how we do it, ladies and gentlemen. So what I'm going to be looking at is, I want to stick to some of these weaker pairs where I have my biases, like the USD JPY that came out yesterday. That will be a good one, and some other pairs as well. So what is the framework, guys? Let me finish with the framework. The framework is simply, first, before any checklist, the mental model you need to hold every time you approach PPI is picture 4 stages. Stage 1 is raw materials. You quickly go over there, check out your raw materials, right? Oil, metals, agricultural imports. Stage 2 is the intermediate processed goods, which is right here that I've just showed to you. Oh, sorry, right there. There we have it, right? Processed goods. Okay, you want to look at processed goods, which we have refined oil, products, steel, chemicals, food processing inputs. Stage 3 is the final demand. We've broken that down, right? We're in 3. Okay, while CPI captures the stage 4. The institutional question on every PPI release is what is happening at each stage. I have a template for that, and you can come in and get it for free, right? What is happening at that stage of the pipeline, and how does it compare to what's showing at stage 4? That is very important. Pipeline running hot at, say, stages 1 and 2, but it's cooling on the other stage, right? Stage 3, that is already an inflation precursor, right? You want to ask yourself, maybe inflation is peaking and the transmission is slowing. When we have hot data coming in at all these stages that we've just looked at, right? Inflation starts to get embedded in the into the economy and these products and starts to spread. So a hot stage 4, for example, and cooling. So we have different variations that you can look at. But the point is to have a very informed understanding before you start to trade. So, ladies and gentlemen, 1, know the date and the expectation of this release calendar. Number 2, you want to identify the primary driver before you assess the reaction on that particular instrument. And then 3, you want to read intermediate demand separately from the final demand. So if you're just using this little chart here to make decisions, you could get caught, you could get whipsawed. 4, you got to stack PPI against yesterday's CPI like I've just done, right? We have both charts, both live data. There's a template for that and a checklist, right? And then you want to come to the 15-minute rule where, you're not doing anything within 15 minutes. You're breaking down this data and you're waiting for the reaction, because we have a lot of algos testing levels during this time. We also have a lot of games from the infrastructure. We're looking at slippage and all that kind of stuff, right? So you want to get the real directional move. And then, of course, we have stage 6, which is you applying your bias to your existing technical framework. And in this case, PPI just gives you direction. Your chart gives you the entry. The institutional participant does not trade the number directly. They always use the number simply to confirm or sharpen the directional bias. And then they wait for price to give them a technical sound entry within that particular direction. Okay? So confirmation candles and all that kind of stuff is good, but understanding the macro view is very important. So this will be a very beautiful trade. If you're following, you can go in. This is not financial advice, but I can guarantee you that we're definitely getting a very nice trade coming out here. We probably will break this. Now, you got to plan your positioning as well. Please use proper risk management. Please journal. I have everything here for free. Just go there, use it, and get protected, right? You don't want to get knocked out at any time, all right? Use this framework consistently, and you will definitely see some good results. All right, guys, with that being said, I want to take both days combined because I've done this simultaneously, CPI and PPI. Right. Let's see how I can frame this, okay? Guys, we'll break this down further into my group. Go check it out. I'm going to prepare for the New York session here and possibly give you some high quality signals. Please like the video. It costs nothing and it reaches the next trader. That is good. Share, follow, subscribe. It's very important to share all this stuff, guys. People are out there struggling. They have no idea how to break this down. And many people are just selling you random bait, which you don't want. So subscribe and turn on the notifications. Every major data release, CPI, NFP, PPI, FOMC, I'll be decoding that live, straight from the source with the institutional framework that you can get right here. And you can actually apply it in real time. You need to be here for each one. So bookmark this and see you guys later on. Stay safe.